Welcome to Yahoo Finance's special coverage of the February jobs report. I'm Seana Smith alongside Madison Mills. We are just moments away from February payrolls print. It's estimated to come in at 160,000. The unemployment rate expected to stay steady at 4%. Of course, a lot of focus is going to be on the month-over-month average hourly earnings. That is expected to decrease to 0.3%. That would be a deceleration of the 0.5% increase that we saw in the last print. When we take a look at that year-over-year estimate, Maddie, that's expected to come in at 4.1%, which would be consistent with what we saw the prior month. There certainly is a lot riding on this print. When you take a look at the action, the whipsaw action, the volatility that we have seen play out in the markets this week, and it certainly seems like investors now reading good news on the economy. It's good news for the market, bad news on the economy, very much bad news here for equities.
Absolutely, and we were speaking on set yesterday with Citi's Stuart Kaiser, who mentioned that the options market is pricing in a 1.7% move in either direction off of the jobs print. It's coming at such an interesting time, like you said, obviously huge volatility in the market, but also just so much bias to pessimism. It feels like we've really shifted so quickly from a bias to the upside to a bias to the downside. So even if we do get a print that comes in line with that 160,000 number that we are anticipating, is it going to be enough for the market to look through it, or is there still going to be that bias to the downside?
Of course, and then some of the factors, of course, weather is expected to have some sort of factor here, the winter storms on this month. There's been lots of talk about Trump's policies, the impact of the Doge layoff, cuts to federal programs, tariffs. That won't so much be reflected in this report. That will be very much as we look ahead to the next print the following month. But again, when you take a look at this potential slowdown that we could see in hiring, fears of a slowdown, of course, that could then put pressure on the broader major averages here as we try to figure out just what exactly this tells us about the health right now of the U.S. economy and, more importantly, the U.S. labor market. Absolutely,
and we are going to get those numbers for you as soon as they cross the wire. We've got those numbers for you. 151, the number coming in at 151,000 jobs for the month, just below that survey of 160,000. And also you had your prior number coming in at 143,000. So again, just about 9,000 below that estimate of 160,000. We also have our average hourly earnings rising by 0.3% month over month. The estimate was 0.3%, so that's bang in line. Now we've got the unemployment rate. This is a key data point here. The estimate for 4% coming in just above that at 4.1%. So again, that non-farm payrolls number coming in at 151,000, just below the estimate of 160,000 here. And that key unemployment rate coming in just a tick above. Also want to mention the average hourly earnings year over year coming in just below the survey data. Survey data showing 4.1% increase. You actually got a 4% increase. Your average weekly hours for all employees also coming in just a touch below the survey data at 34.1, just below that 34.2 number. So a very slight miss on the headline number, a slight tick higher in your unemployment number. Interesting to see the market rallying off the back of this, just a touch here.
Yeah, it is a little bit interesting. Let's talk about that market reaction, because I think that might be a bit surprising, maybe perplexing to some of the viewers there. We want to bring in Steve Sosnick. He's Interactive Brokers chief strategist, also Joe Bruce-Wallace, RSM's chief economist. Steve, just to go to you on the market reaction, the fact that this print came in a little light, 151,000, again, unemployment rate rising to 4.1%. Why aren't we seeing more pressure on equities right now?
What we've seen isn't enough for you, Seana?
I don't know. There's lots to talk about. If it were to be a miss in any regard, then we could maybe see a further swing to the downside.
My reaction when I saw the numbers was this was close enough. Yeah. We landed the plane. You know, maybe it's a little bump on the landing, but it was fine today. And I think that's what you're seeing now is a bit of a relief rally. You know, we've been under so much pressure. We still see customers who just are eager to look for a buyable dip, and they've been quite disappointed in trying to find them. And so I think right now what you're seeing, at least for the morning, at least the initial reaction, is a little bit of a sigh of relief, and the sigh of relief is allowing some buyers to step in.
How far do you think this goes to the upside today?
Depends on what the news flow is. I mean, literally, we've been buffeted by news flows. I think, I think some of what we've seen is interesting. Is we have seen these very, very big FOMO-driven rallies. They can get extended on Fridays because of weekly option expirations.
Sure.
You have the daily expirations in the index futures, but 600 and over 600 other products expire today. You run through some strikes. You can extend a move in either direction. So let's see if the good feelings persist. But I wouldn't be surprised to see just sort of like them trying to gun it later if it's all been quiet.
I also want to note the revisions here for December, up by 16,000. For January is actually revised down by 18,000. Not too much of a movement there, netting out just 2,000 lower. Joe, when you take a look at this print, combining the average weekly hourly earnings that we're getting as well, the year-over-year move that we're seeing, is it a solid print in your view?
It's a Goldilocks print for the context in which we are living right now at this moment, at this second. Market's going to look right through this. We know that over the next 3 to 6 months, we're going to see some of the disruptive effects in Washington start to show up in both the economy and in the labor market. But for now, what this tells us is that, we really only need to add about 100 to 150,000 jobs a month to keep employment stable. That's exactly what happened. The acceleration in wages last month was due to work hours. That was a statistical mirage. The fact that we reset back to 0.3 and we're looking at 4.1%, all of that's pretty good. Now, we got to dig into the detail. I was able to see that the BLS said that the fires in Southern California had no discernible impact on this report. We do want to see how many people weren't working due to the bad weather, and I think that's going to be quite large. As we move forward, though, guys, you should expect hiring to slow to somewhere between 100 and 120,000 per month, which is, again, more than enough to keep the unemployment rate stable. And that's got to do with probably state and local government pulling back on hiring because of the uncertainty around cash flows from the federal government to the states. That's going to be a bigger part of the ongoing story going forward. But we really got to dig into the detail here to see what the private sector did.
Well, what's interesting about that is I just wanted to tell our audience that we do have federal government payrolls falling by 10,000 jobs month over month. So I guess the market might see that and think, okay, well, that's why we had the miss of 160,000. That's about 10,000 jobs there. But how bad do you think the jobs numbers could get once we do have the full impact of those Doge cuts priced in?
They're not going to be bad. We have a very tight labor market. Labor imported from the external tech sector has slowed basically to zero. So you're just not going to see a surge in unemployment because federal government hiring slows to zero or cuts. I had 160 today on my forecast, had 4%, 0.3, 4.1. You want to know why I missed? That federal government hike, right? That's exactly why.
I gave it to you, Joe.
Yeah, you did. I'll take it, Madison.
Yeah, when you take a look at some of these other sectors as well, healthcare adding 52,000 jobs during the month, financial activities adding 21,000, transport warehousing adding 18,000. I guess, Steve, the question is whether or not this is enough in order to not only regain some of that lost momentum, but keep that momentum. And I know you were saying much of that's going to be driven by the headline news and what we get throughout the day, obviously, in coming days and weeks and months. But how are you thinking about how large of a sell-off we have had, the fact that the NASDAQ is in correction territory? Maybe this is enough to spark some of that buying activity.
It can be. I mean, certainly a lot of the metrics, the technical metrics show us being a bit oversold. But it's different when there's sort of news flow. This wasn't really just sort of like let's give up a little bit of the gains. There has been some news flow. One of the other issues you see is I think there is just a general sense that the economy is not as strong as people had hoped or thought it was. Remember, about 6 weeks ago, the talk was for one rate cut in 2025. Now we're looking at 3 or more. And so there's a big change there, and stock markets do ultimately react more to the economy than they do to the rate cut picture. And I think that is one of the things we have to work through. I think people want a little more clarity on the state of the economy because I think people got a little spooked.
I would think that this would take some of that pressure off the Fed.
It certainly does. And I think my fear actually is more that the Fed is slow to react because I think the Fed is waiting to see really the full effects of the federal government moves, whether it's tariffs, how are they supposed, if we can't plan, they can't either. And I think there is the risk that the economy slows faster than the Fed is able to react. That I'm not saying necessarily is the base case, but I think that fear has entered into the market and is weighing on things a bit.
I think there's some evidence of that slowing in this print too. When you take a look at the U6 underemployment rate soaring to 8%, the highest level since October of 2021. Joe, I know you're looking under the hood at some
and there's a reason why that happened because 1.3 million people who are working part-time and looking for work weren't because of the weather. Then the 404,000 again who were normally full-time workers just weren't working. This actually probably understates the strength of the labor market, to be honest with you. So when I see the market setting up for 3 rate cuts, Steve, I'm thinking, maybe not, guys.
Okay.
Yeah, we'll have to wait and see what the tariffs do on the margin. I mean, we're hearing from corporate CEOs, they're going to pass prices through quite quickly. We're not going to see the same reaction function out of the corporate sector that we did in 2018. Yeah. They're moving, and in many cases, they're hiking prices ex ante, even before they show up.
Well, Joe, how disruptive should the markets be thinking tariffs are going to be?
25% serious number. We shouldn't. We should take that both seriously and literally. The CEO of Ford, I think, was right. It would blow a hole in their business, right? Mm-hmm. Which is why it didn't happen. I'm encouraged by that, right? We don't have to engage in Trump bashing here. Mm-hmm. They didn't do it. We'll see where we get next month. Of course, none of us like that. You know what my clients really want to know? They want to know what the darn rules of the road are going to be, so they can hire
everyone
people
wants to know that.
And make investment. I think at one point, Scott Bessent and the economists inside the White House, the logic of this will prevail, but it's just going to be a while. I'm enjoying riding the volatility machine every day, guys. It's quite something. No, seriously, I've gotten back in touch with a lot of my quantitative framework, and we can see the market was very offsides this week. The positioning across asset classes, and we paid a price for it, right?
Yeah, and that's I think the key here is, I think everybody's waiting for the clarity. Uncertainty produces volatility. I'm an option trader by heart. I love volatility. I live for this. But it does. Not everybody does. But investors can't stand it. You have to sort of have a certain mindset and a certain training to be, to enjoy this. But I think that what you're saying is very true. I think Bessent. But it's even there, the focus on the 10-year is tricky for a lot of people because it moved the goalposts. We came in to the administration thinking that the prior Trump administration was very focused on the stock market. Now we're supposed to focus on bonds, and one way, as you know, Joe, is to get bonds down. If you want bond rates lower, the economy, a bad economy, will do that too. So you got to be careful what you wish for.
The interesting thing is that we clearly are in a late cycle slowdown. Right? We're having a classic growth scare. The corporate sector is very sensitive to the 5-year yield, the public to the 10-year, because that's a benchmark for mortgages and credit cards. When I see what's going on and I think, okay, this is a legitimate growth scare. M&A activity in January was down 30%, even though yields fell. That's not what you want to see. You would expect to see the opposite. Therefore, they're going to have to, at one point in policy land, get out in front of this and say, here's what the rules of the road are, and then they're going to have to stop.
Unless they want economic weakness, which some...
Well, I understand that that's a very counterintuitive talking point. When I watched Bessent this morning, I see real reticence about talking around inflation and where the 10-year is. That, to me, doesn't seem like they want the economy to slow down. Yeah. I like this administration. They have very easy tells. When the big actors start to talk, whether it's Howard Lutnick or the Treasury Secretary or the Vice President, you can see what the tell is.
Yeah. All right, guys, we've got to leave it there. Thank you both for joining us on our special coverage. Always appreciate it. Steve Sosnick and Joe Bruce-Wells, thank you for joining us. We're going to send it over to our own Jared Blickery for a look at the movers on the back of that February payrolls print. Hey, Jared.
Hey, thank you, Maddie. I've got my own tells here, and they are charts, and they're giving a wealth of information. Let's dial up the Wi-Fi Interactive, and we'll start with the Dow. That is slightly negative here. The first reaction was to the upside. Stocks futures, I should say, were kind of rallying on that Goldilocks report, not too hot, not too cold. I did hear that word at least once this morning, so I'm going to roll with that. And the Russell 2000 futures are up the most right now, 0.4%, but they have given back some of those gains from that initial spike. But what happens today during the regular market, and especially into the close, is what matters here, as is always the case. And a lot of times we get a reversal early in the trading day once stocks open at 9:30 a.m. Eastern. So let's take a look at Treasury note futures. These move opposite rates. And so right now we can see they're heading up. This is a 2-year tenor. That means the 2-year rate is heading down. And let's see the 10-year, very similar story, but it's heading down by a little bit more. So that's something that we will follow today. And we'll have to get a check on gold futures because those have been elevated recently. We saw a little bit of a dip, but now they are on the rise again. Key number is 3,000. Haven't ever hit it, but that is a big psychological target. Also, let's take a look at silver futures. Those were already depressed, but we can see those got a little bit of a jump here. And I do like to check in on crude oil, although it doesn't usually move in reaction to this particular report. I'm not seeing too much movement there, up 1.5%. 1.5%, but prices have been pretty depressed recently, so that might just be a reaction move to the upside. And then here's Bitcoin. We're seeing just a tiny little bump here, not a big reaction. And I do follow Bitcoin seriously around these reports because it can be a very risk on, risk off barometer. And finally, let's get a check of the sector action. Now we see kind of a mixed board, materials, and by the way, the color in the background is what happened yesterday. So materials, XLB in the upper left, that was down 0.5% or 52 basis points. It is up this morning by 87 or 0.9%. And then second place, we're seeing energy, and then third, tech and industrials. So the leaders here have been rather depressed recently. Here's an XLE chart. I'll put a 1 month chart, and you can see it's been heading down since about the middle to end of February. Same thing for tech. So we might just be seeing a reaction to the upside. What has been down is going up and vice versa. And here's real estate, by the way. That has been rather strong recently compared to some of the other sectors, and that is in final place here, leading to the downside. So kind of risk on reaction, but as always, we want to keep our eyes peeled and really study what happens in the early part of the day and then into the close.
We certainly will wait and see. All right, Jared, great stuff. Thanks. Coming up, we will have much more on the February payrolls print and a look at what sectors gained and lost the most jobs during the month of February. That's coming up next on Yahoo Finance. The U.S. economy adding 151,000 jobs in February. The unemployment rate changed a little at 4.1%. Joining us now is our very own Alexandra Canal for a deeper dive into these numbers. And Ali, once you break it down by sector, the initial reading, there was a lot to like in this report. Of course, government, though, maybe alluding to some of those larger cuts that we could be seeing.
Yeah, and this was a sector we were really focused on, especially from that data that we got from Challenger, Gray, and Christmas that showed increased layoffs, citing specifically those government layoffs. We saw federal employment decline by 10,000 jobs in February. Now, on a month-over-month basis, this is pretty significant. Government employment trended up in the month of January by about 32,000 jobs. In fact, the monthly gains throughout 2024 was 38,000 for this sector. So this is a sector that has consistently added to the gains that we have seen throughout the past year. It's likely that we will see some type of impact from these DOGE-related layoffs once that's fully realized. We did see that federal hiring freeze on January 20th. We didn't have layoffs, though, announced until mid-February. So for the purposes of this monthly jobs data, many of those impacted workers, they're probably still going to be counted as employed based on the reference period, along with when the survey was conducted. We really have to monitor the weekly claims data to see any material changes or impact there. And to that point, we saw sort of a muted reaction. We did see over 1,500 weekly unemployment claims filed in D.C. for the week ending March 1st. That's down from the roughly 1,900 that we saw the week prior, but still very elevated compared to what we've seen over the past year. Another thing to keep in mind is that 75,000 employees took a federal buyout. So they are going to be receiving a paycheck through the fall, and they will be counted as employed through this survey. So not a sizable drag yet, but that is the key word here. We have yet to see the impact. Doesn't mean we're not going to see the impact. Likely we will continue to see some trickle down effect in March, but again, remember that likely throughout the year, we are going to see more and more of potentially a downward trend. And then finally, real quickly, I just want to mention retail, because retail woes that was cited in the Challenger data. Employment and retail trade changed little over the month, a loss of 6,000. Little net change over the year as well. Employment in food and beverage retailers declined by 15,000. That was largely due to strike activity. Warehouse clubs, supercenters, and other general merchandise retailers added 10,000 jobs. And we did see a disappointing retail sales report for the month of January. So another sector that we continue to watch closely as we really gauge the health of the U.S. consumer.
It also sounds like, Ali, in the great breakdown that you just did, that a lot of it can be explained away. Any of the weakness can be put back to the seasonality, the weather patterns, some of the job cuts from the federal government, which I guess we're kind of ignoring for some reason until it's more serious next month. How much pressure does that put on the upcoming economic data then?
Yeah, I think it puts a ton of pressure, especially through the spring, heading into the summer. I mean, the jobs report is something that we know the Fed is very, very focused on. It's part of their dual dual mandate. They want to maintain maximum employment while making sure that inflation is still coming down, and inflation has been stubbornly elevated. So if we continue to see, inflation going to the upside and any deterioration on the labor side of the picture, that is going to convince the Fed to cut rates, perhaps more aggressively than they initially intended to. So this report, this monthly data set, it's something that the Fed is very, very focused on, and something that investors are focused on as well. And the fact that we are seeing some gains today in the markets, considering the expectation heading into this print was, if this is bad, it's going to be real bad. But the better than feared report in a lot of ways, especially since it's a little average.
Yeah, and I think it's that fear word, right? I think this very much reflects just how much fear has already been introduced and already is priced into the market at this point. The fact that we are seeing the degree of the relief that we are on a print that did miss on the headline number, that did see an uptick in unemployment. Once you do look underneath the hood, there are some issues that you could clearly take here with this print. So I think it very much just reflects that fear that is obviously has been creeping into the markets and very much apparent in the recent trading action.
Right, today at least, glass half full, but we'll see markets can flip very easily.
They certainly can, as we have seen. Exactly. All right, Allie, thank you for joining us. We appreciate it as always. Well, the bond market rallying off the back of that February jobs report, suggesting softer jobs reports could be ahead after today's numbers came in slightly softer than expected. Joining us now is Blake Gwynn, RBC Capital Markets head of U.S. rate strategy. Blake, great to speak with you. I know that in terms of the action that we were seeing this morning, it looks like the market's pricing in about 75 basis points of cuts to come this year. Do you think we're going to see that?
I personally do not. We're still holding on to our call that we're at the terminal rate. I think some of the conversation you guys were just having kind of hits the nail on the head. Is that the Fed? This is okay data for the Fed on the labor side. I think they're still dealing with some pressure on the inflation side. But I'll caveat that by saying, probably the last time I talked to you guys, I really saw the risk skewed more to the upside. We were still kind of riding that positive wave of optimism coming out of the election. Those risks have certainly turned to the downside at this point. So even though we're not really calling for any more Fed cuts, I really do understand why markets are starting to kind of reprice that Fed path going forward. Because if this softness that we're seeing in some of the survey data starts to translate into weaker hard data, that's when you're going to see the Fed start to react. And that's something I'm watching very closely for in the next couple months.
Blake, what does the real risk of that look like?
Well, look, I think, all this discussion you guys are having, we're having on the desk around, how much this report incorporates government layoffs, the kind of analysis around, tariffs, how long, if X, Y, and Z tariff are in place on these products for this amount of time, what does it mean for price? What does it mean for CPI prints, et cetera? Those are useful in putting context around the data prints. But I think if you just abstract away from that, I'm much more worried about the uncertainty that this is causing. And I think your two last guests, I think hit on some very, very important points, which is that businesses and consumers, they like a stable environment, a stable, predictable environment. And if you're going to make changes, I think those changes, if they're well telegraphed, well understood, and very smoothly kind of rolled out, that is what allows businesses to plan. It's what allows consumers to feel confident in taking that vacation, buying a new car. And I worry that a lot of the chaotic nature of how these things have been rolled out has instilled uncertainty and fear into the environment, which is going to start dragging, CapEx, investment, hiring plans. I just think it's going to be a very difficult environment for businesses when you don't really know what the roadmap's going to look like. So that's something I'm really watching for in the next couple months to see if that starts. But this month's data, it's too early to see that. We can see the Doge. The government layoffs, but it's way too early to see those second and third order effects on how it's affecting confidence and uncertainty.
So, Blake, I guess what is necessary in order to recover from some of that bruised sentiment that we clearly are seeing here in some of that survey data?
It's hard to put the toothpaste back in the tube, right? They can kind of settle down a bit. I think you've already seen in the last week, they've realized how this flurry of Doge headlines has been affecting confidence and been affecting the narrative. And I think there's been a bit of a slowdown. I haven't noticed over the last month quite the fury of kind of headlines we were getting in the first month of the administration. So I think maybe they pulled back a bit there. The tariff stuff, even though they've kind of pulled back on these tariffs multiple times now, it's the stop and start that's the bigger problem to me. If tariffs go into effect, we'll start to figure, and we think that they're going to be lasting. We'll start to figure out what the long-term impact's going to be. But I'm actually worried about just the introducing and then pulling back itself. That uncertainty is lasting because I don't know how, if I'm in a planning seat at some kind of large business or even small businesses that rely on government infrastructure, government contracts, government grants, how do I have any confidence about, investing in my business or expanding or, purchasing new equipment, et cetera?
So Blake, is it, and we have about 30 seconds left, is it right to characterize your take as the economy is in good shape, let's just not muck it up with any policy changes?
Yeah, exactly. I mean, it's really waiting to see, how much damage. I think if we continue this uncertainty, there's more damage that could be done. But then there's just the second question, which is what we've already done, how lasting is it? To the last question you just asked, I mean, it's the toothpaste back in the tube idea. It's just how much damage to the psyche and to the confidence has already been done. For 6 months, are you really going to be confident that you're not going to walk in and realize that your business has been fundamentally altered by a tweet or some kind of announcement out of Doge, et cetera? So that's going to be tough.
Certainly, and obviously we're seeing the jitters play out. Blake Wood, always great to have you. Thanks so much. That does it for a jobs report special. But keep it right here on Yahoo Finance. We got much more jobs coverage right after the break. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Seana Smith. Let's get you the 3 things that you need to know today. First up, stock futures pushing higher after the February jobs report showed 151,000 jobs added during the month of February. That was below the estimate of 160,000. Today's jobs report, the latest evidence that the labor market is softening just a bit, just as President Trump's policies raise some concerns about the broader economy. Plus, Bitcoin bearing losses this morning following initial declines after President Trump signed an order creating a strategic Bitcoin reserve, an additional stockpile of other digital assets. The reserve will be capitalized with Bitcoin already owned by the federal government, and any further additions will require, quote, budget-neutral strategies that impose no incremental costs on American taxpayers. This order coming ahead of the gathering of crypto executives at the White House later on this afternoon, where they're expected to meet with President Trump and the White House crypto czar David Sachs to discuss the industry's outlook. And signs of optimism for the AI trade, Broadcom shares surging to the upside by the most in 3 months after the company gave an upbeat forecast that was driven by strong demand on AI spending. A sign of relief for the trade that has been under a bit of pressure as of late. Meanwhile, Goldman strategists calling for a rotation back into AI, saying that investor interest in artificial intelligence trade is likely to be revived as stocks show technological progress and earnings growth. So again, they're seeing a buying opportunity there. We'll see how it all plays out. Stock futures now in the red here this morning on the back of that February jobs print. What does this mean for the sell-off? Some of the pressure that we've seen, more broadly speaking, across the market, the Fed, and the economy. Joining us now to break it all down is Josh Schaefer. We also have my co-host, Madison Mills, still joining me here for this hour. And Josh, help us make sense of this. We did initially see some relief. I called it in a question. Steve Sosnick was telling me that, hey, it actually makes sense to him. Now we're seeing a bit of a pullback.
Well, and Jared said off the top, right, our Jared Blickery, who follows the individual moves very closely, right, those minor moves that a lot of times on the jobs report, you might see a little bit of a reversal as we start to actually digest the report. I just don't know how much this report really changes the market mood, right? So if the fear has been a little bit of a slowing economic data, right, weaker than expected data, maybe this report doesn't fully feed into that. 151,000 job ads, that's a good number. You're not going to hear a lot of economists circle that number and be very worried about it. But the unemployment rate did move up to 4.1%. And overall, this doesn't have a lot of the uncertainty we've been talking about in the report, right? Mm-hmm. So yes, we saw 10,000 job losses for federal government employees, but this survey happens in the first 2 weeks of February, right? It's early in February when this survey is taken. This doesn't have tariff concerns from companies in it, right? So it's just not necessarily the report. I think maybe your March jobs report might have some more of that impact in it. And so net, if the market has really been worried about tariff uncertainty and that's what brought the NASDAQ into correction yesterday, this jobs report doesn't really give you that much more confidence. What it didn't do is be overly negative, right? I think the fear was that this would be an overly negative report and fuel more selling.
I'm wondering where we're going to head today, which, of course, if I knew that, then I wouldn't have to work because I would be a millionaire trader. But I'm wondering because we've got Nvidia up pre-market. You said this morning, my favorite line of the day, Josh, you're looking at it as a stock market, not a market of stocks today. But if we do see some movement to the upside in some of these big tech names, does that get us back above some of the losses that we've seen throughout the week? Is that enough to carry us into out of a downward week that's seen a lot of selling and pressure?
It feels like no, Maddie, right? So Broadcom had strong earnings last night, right? The stock's up 8% right now pre-market, and we were just showing NASDAQ futures that are slightly down. So if your AI trade, you got one positive actual fundamental catalyst for one of the biggest stocks in the market, one of the AI stocks, and as you said, that then sends Nvidia up, and NASDAQ futures still are not up, that gives you a sense of the market mood right now, right? Because there's been versions of this AI trade over the last 18 months where when you get positive AI news overnight, we come in on Friday morning and we're talking about NASDAQ futures up over 1%, right? And it just doesn't feel like that market right now. And to your point, headed into a weekend, we're talking to more and more strategists right now that are talking about maybe you just don't want, it's a market that people don't really want to be in over the weekend, right? We've seen a lot of selling on Fridays recently because of all the political headlines you get over the weekend, and then so you just have a lot of change happening all at once, and so it's tough to maybe be exposed from that sense too.
And then of course I think that begs the question about what investors are going to do, what they should do in this type of environment. Obviously that is the $1 million trillion question at this point. But again, when you see conflicting reports, when you have this unpredictability coming from the White House, you think that would lend to maybe to some degree to some hesitation and people waiting for some of that fog to clear.
Yeah, it seems like it's still a little bit of a wait and see, right? And we haven't brought up the Fed yet, so I'll bring in that part of the conversation as well. But when you look at Fed funds futures and what's pricing right now, didn't move that much this morning, right? We were pricing in 3 cuts before this report. We're still pricing in 3 cuts for the year after this report. The debate was really around if they're going to start cutting in May at about a 50-50 debate, still kind of sitting there, right? Again, off most jobs reports, at least the futures markets for Fed funds futures are moving quite a bit, right? We didn't see a lot of movement. And I think to your point, Seana, that just speaks to the overall cloud that we have right now and waiting for some of that cloud to be removed. Because again, we're talking about a May meeting. I bet we're going to learn a lot more about policy between now and May and also get some more data.
Certainly will, you would think. All right, Josh, great stuff. Thanks. Well, tech stocks selling off this week, but could there be some signs, or there are some signs of relief here, at least early this morning? Results from Broadcom offering an upbeat forecast driven by AI demand. If gains hold into the open, shares will be looking at the best day that we have seen in just about 3 months. We're now looking at gains of about 9% here in the pre-market. Joining us now for more, Yoshioka Wealth Enhancement Group Portfolio Consulting Director. I am so sorry there for butchering
That's totally fine.
But thank you so much for coming in. Talk to me about some of that selling action that we have seen in tech stocks here. You have the NASDAQ in correction territory. Lots of questions about whether or not now is the opportunity to buy that dip. What do you think?
Sure. So I think time frame matters, right? And when you look at the long term, I think the AI spending is clearly going to continue. The hyperscalers aren't going to pull back on the budgeted capex that they've already announced. And these are table stakes for a lot of these hyperscalers. So that spending is likely to continue over the next several years. Probably not at the same pace that we've seen. It was really rapid over the last 2 years. But the volatility that we're seeing in markets is potentially a buying opportunity for those who may not have been exposed. But if you haven't been exposed already in the last 2 years, it's tough to find, right? People are pretty much topped out, and so I think that's where people are taking a little profit, at least in the near term, and then seeing whether or not they can get back in at lower prices.
How are you thinking about earnings growth moving forward and just kind of the sky-high expectations for these big tech companies? If that starts to come in, is that good news for those individual names?
I think it's more about the overall free cash flow because the capex spend has been the biggest concern, right? Like the capex spend is necessary in order to continue to be, you have to spend in order to have the table stakes for AI. Everybody's trying to figure out how do we make sure that we are in the pole position for AI. And then I think that has eaten into that free cash flow that was so great about all of these tech companies in terms of returning cash to shareholders. So that's going to be more of the something we watch.
Yeah. When we're trying to figure out, I guess, what that buy signal is or where that opportunity is, how should investors be comparing those obviously that have outperformed clearly the Mag 7 versus some of those phase 2, phase 3 sort of AI plays? Yeah.
Sure. So I think it just depends again on your risk aversion and how much growth and return enhancement you want to see, right? So I think a lot of the Mag 7 companies, they suffer from the law of large numbers. They're very large at this point, and so having those high growth rates is difficult. So then you go into the second and third tier tech companies that may have higher growth rates that can benefit from AI a little bit more than the bigger hyperscalers can.
And when you talk about free cash flow, I'm also curious about the impact of the DeepSeek of it all and whether or not that hurts the AI thesis just because it potentially proves that you don't need to spend as much money on your AI training. What are you thinking about that?
I think the bigger sort of narrative, at least in the market, has been that DeepSeek introduces the fact that maybe US companies won't be in that pole position. They're not going to be the leader in AI, just in AI in totality. I think it at least opened up the question, is it possible, right? And it's not necessarily that it's just going to be cheaper or more expensive. I think it's just where are we, and are we going to be the lead? And I don't necessarily think that DeepSeek is going to upend our current lead in AI, but it just opened up that question, and it turned that whole American exceptionalism story sort of up on its head. Yeah. And I think that's been more of the issue.
Is it overall bullish, though, for the sector? When you take a look at just the widespread adoption and what that could do and enhancement just in terms of that spending and obviously CapEx going forward?
Absolutely. And then, Jensen Huang himself talked about how, the overall just the reasoning that is, developing with DeepSeek, all of that allows for more, like 100 times more compute power that you need in order to do that reasoning on the back end. And so I do think the overall spend is going to continue to increase.
So is your base case for Nvidia still bullish?
I think over the long term, yes.
But how long term? Yeah. How long term?
Well, I've been following Nvidia since 2003 when they were just a gaming GPU company, and you were following it for the console cycle for PlayStation and Xbox. And during those last 20 years, they've gone through many cycles in which the drawdowns are over 50%. At one point it was because crypto mining was a large portion of their revenues. And so I think you don't bet against Jensen, and I think you stay with Nvidia. They've been able to recreate themselves many times, and I think they've been at the forefront of a lot of technology at each cycle, and there's still autonomous driving and all sorts of humanoid robots that might also be an area that they can participate in.
How are you, once we take a step back and also just factor in the macro environment right now, we do have softening econ data. There's clearly some concerns that has been triggering some of the selling that we have seen on the street. Then you take a look at Washington, the unpredictability out of there. How big of a factor do you see that being to the tech trade?
It's a huge factor because I think that volatility is something that we haven't seen in 2 years, right? We had 2+ years of back-to-back 20% returns driven by the tech trade and AI and the thematics there. And I think that seeing this uncertainty, seeing the volatility is scaring a lot of investors.
And I wonder, too, just how you're thinking about the impact of those export controls and which companies are best positioned to be nimble, to navigate the uncertain policy backdrop. Are there certain things investors should be looking for when it comes to individual names that position them better than others?
I think in the short term, it's hard to say that, but so I think we always go back to the longer term and then the quality of the company in terms of, what does their balance sheet look like? What type of growth are they, seeing? What end markets are they participating in? And we know that some of these politics are going to shift things around in the short term, but if you can get the end markets right, the geographies will sort of work themselves out.
That makes sense.
I echo. It's always great to have you. Thanks so much for taking the time to join us. When we turn now to the jobs report that came in earlier this morning, coming in slightly softer than expected, you do see stocks pairing some of those earlier gains. A headline number coming in at 151,000. That was just below the street's expectations of 160,000. We did see a slight rise in the unemployment rate. We're now looking at negative territory here for all three of the major averages ahead of the open, on track to open to the downside here. And Maddie, as we do discuss this print here, obviously there was some to be encouraged about. We didn't see any sort of significant weakening across the board. The market's very much initially taking that as a sign of relief, but it is important to point out that this data did omit some of those larger government cuts that we have been talking about over the last several weeks. Whether or not that points to a significantly weaker print next month, I think, is on investors' mind, but also just what it's going to take in order to ease some of those jitters out there that we have seen creep into the markets.
Yeah, I think it's really interesting monitoring the market reaction here. We saw an initial relief rally, and then Cameron Krice, he's a macro strategist over at BI, talking about how that slight jump in unemployment to the upside at coming in at 4.1%, that could be informing the reversal of that initial relief reaction off of the headline number not being so bad. Even though it was a miss of 9,000, it wasn't too significant, obviously, and you can account for some of that in the loss of government jobs to the tune of 10,000. Another data point I was talking about with our guest this morning, Sean, is that U6 rate. That's a measure of underemployment, whether or not you're getting the amount of hours that you want, helps you look at the health of part-time workers in particular. That jumped to its highest level since October of 2021, and household employment dropped by 588,000. So I think that points to this question of, are we already slow, or are we in the process of slowing? And if we're in the process of slowing, does any policy from the White House push us into slow is going to be the key question. And maybe we'll get some more insight into that as we continue to get economic data in.
Yeah, and as we discussed with Ali earlier too, it just clearly illustrates just how much fear there is right now baked into the market right now, and how much remains just given so much of that uncertainty. Josh was talking earlier about how the Fed plays into all this, what this could potentially mean for rate cuts here down the line. Obviously, that is a factor that investors are trying to figure out as well. But again, we will see what today holds, because it's already been a pretty whipsaw action here over the last 45 minutes since that number broke. Well, coming up next on a morning brief, we're going to count you down to the opening bell on Wall Street following that February jobs print. Plus, we take a look at Tesla, one analyst naming it a top pick. Walgreens is set to go private for $10 billion. We're going to bring you those details next. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of this session, all done with Yahoo Finance's trending tickers page. First up, let's take a look at Walgreens. Walgreens finalizing a $10 billion deal with Sycamore Partners to go private. Yahoo Finance's Anjali Kimlani here now with the details. And we were talking about this. We've been talking about the possibility of this now for quite some time. But again, now we have that valuation, the price tag, $10 billion.
Absolutely. So $10 billion, and it's up to $23.7 billion. That's including potential future fate, if you will, of Village MD. And so there will be an additional option there. So what this represents is $11.45 per share. And that is a 29% premium on the closing price right when negotiations started. So we're looking at a bit of a premium that Sycamore is willing to pay for this company. And of course, recapping the fact that this once was a $100 billion valuation company just 10 years ago. And we've seen the decline based on what is pressuring really all of retail, and that is those store locations, which Walgreens is already closing down. We don't know what will happen to the various parts of the company. That includes a specialty pharmacy, home health care, Village MD, as I mentioned, the pharmacy benefits manager. So there are a lot of moving parts there, and it will be interesting to see how Sycamore pairs off with this. There are rumors that they could split the company. That includes the Boots part of it, and having that separately. It's a very strong asset under the Walgreens umbrella, but more to come. I think more closely to earnings time right now. They're waiting for that Q2 for more information. So this is what we have right now. And as you mentioned, Shauna, it's been on the table for some time. It's been a 4-month-long negotiation process, and just another company going into this space, just like Rite Aid we saw come out of bankruptcy and go private.
And are we expecting any sort of potentially competing deal at this point? And then also, I'm just curious how analysts are thinking about this, and just the ability for even a name like Sycamore to turn around a business like Walgreens.
No word yet on the competing. So the analysts are intrigued by this. We obviously saw, you can see the stock up on the news, nearly 7% pre-market. And that is something that tells you just how much that they've been looking for this deal. There's been so much pressure on the front end of the stores and wondering whether or not Walgreens can kind of catch up to what CVS did. If we look at among the retail pharmacy giants, CVS has a better name, even though they too have their struggles. Analysts have told me. I spent a lot of time on the phone yesterday, and this is basically the roundup of what I got, which is finally a good deal and waiting to see how it pans out. But it seems like with all the various parts, what Walgreens was unable to do to survive the way CVS is sort of pivot in the same directions. There's no insurer that became part of the company. And there are other aspects that maybe they tried to implement, but just not at the scale. And they never really got to that point of really, getting to profitability on some of those things. So that's really why you see the stock up on this news, even though, ironically, I say it's coming off the market. So who knows about that stock in the future?
Yeah, great. So thanks so much for breaking this down. I have a feeling it will be far from the last time that you and I are speaking about this. All right, let's turn to Tesla. Tesla, a trender here at Yahoo Finance this morning. Shares actually off just about 1.5%, but the company did get an encouraging boost here from Wedbush Securities. Dan Ives adding the stock to its best ideas list, reiterating an outperform rating, $550 price target. Ives writing that the bears own the Tesla narrative in the short term after that recent sell-off, but still he says that this is the start of the biggest innovation cycle in Tesla's history. Maddie is here to help me break it all down. And Maddie, when you take a look at this, Ives has been very consistent on his bullishness here for Tesla. He's a big believer in what the stock is going to look like, AI adoption, full self-driving, so not necessarily a huge surprise that this is one of his top picks here, but I think it does come at an interesting time. Obviously, Tesla shares have been under a tremendous amount of pressure. There's been some concerning data coming out regarding sales overseas, even ultimately what that could mean here for the U.S. for the Q1 delivery numbers. And then, of course, factoring in the possibility and maybe some evidence that we're already seeing reflected in those numbers of the backlash there just from Elon Musk being a part of the Trump administration and some of the action that he's taken over the last several weeks.
And I thought it was interesting that he addresses the elephant in the room, Dan Ives, in his note. He says he thinks less than 5% of Tesla sales are at risk from the political environment impacting how people or tainting how people feel about Tesla. He also says he sees autonomous vehicles and Optimus, the robot, representing 90% of Tesla's valuation moving forward. So that makes sense to me, right? This idea of the fundamentals of the business moving forward being a bull case for the company. But I have to wonder how that impacts the stock price, because historically we've seen that the company fundamentals aren't necessarily what drive this stock. We had the presidential election results, for example, driving the stock to all-time highs earlier this year. So it'll be interesting to see kind of how the stock's volatility coincides with any business fundamentals.
Yeah, certainly. And we have the stock trading at just below $260 a share ahead of the open. All right, let's move on to Costco. A read on the consumer reporting mixed results for the fiscal second quarter. The wholesaler warning of a cautious consumer spending due to inflation, the potential impact of tariffs. The company saying that fresh groceries were, quote, the most inflationary category in the quarter. That was driven by higher prices for meat, for bakery goods, and for eggs. You're looking at losses of just about nearly a 2.7% dip here in pre-market trading. I think the big question is when you take a look at a name like Costco, Maddie, I think many investors maybe initially think that they would actually be able to weather some of these headwinds if consumers are pulling back on their spending. Maybe they are looking for more of those deals, ones that you would get at Costco. But the fact that we are seeing some signs of deterioration or trepidation, concern here amongst consumers when it comes to their wallet, this could be a larger signal just in terms of what could be in store here over the next several weeks as we do hear from some more of these larger retailers.
I think it's interesting to see the degree of the sell-off given how positive some of the analysts still remain on the print here. We had Baird talking about how, to your point, they are well positioned to handle any policy risks moving forward here, and that they had strong numbers when it comes to performance indicators like comp sales, traffic, membership growth. You also had JP Morgan saying that they have continued global momentum in the business, and the fundamental story for Costco challenges all of the other best companies in their coverage. That is a huge positive sign for the stock, I would imagine, and JP Morgan maintaining their overweight on the stock. But of course, it sounds like because of the just numbers coming in from this print that we're a little bit disappointing here, especially given that second quarter profit trailing estimates. That's what's driving the stock down, though the long-term and more fundamental story for the business could be a positive lift as we head through the rest of the year here.
All right, Maddie, thanks so much for sticking with me this morning. All right, coming up next, we've got the opening bell for you on Wall Street. We'll be right back. Final trading day of the week as we bring in the opening bell on Wall Street. Investors digesting the latest econ data that we got out this morning. That jobs report coming in slightly below expectations here. Unemployment rate ticking just to the upside, introducing a little bit more uncertainty into the market. This, of course, following some of the fears regarding tariffs, the policy coming out of Washington this week, also some of that concerning sentiment survey data that we have been getting, fears of an economic slowdown. That clearly has been reflected in the market as of late. And now here we are at the open. Now we are seeing a bit of a pullback here across the board. You have the Dow opening up just off about 0.4%. You have the S&P also in negative territory. Now, this downward move is a little bit of contrast to the initial reaction that we saw to the jobs report right at 8:30. We initially saw some relief that quickly reversed here. And now here we are in the red once again, where we have been many times over the last several trading days. The NASDAQ falling into correction territory yesterday. We are seeing some further downward pressure there again today. Taking a look at the bond market and the reaction that we saw there to that jobs print, we are seeing a bit of a move to the downside. You got the 10-year yield right around 422. Quickly taking a look at the sector action here this morning. At the start, you have energy, utilities, real estate, the only sectors holding on to slight gains here at the open. A lot more time, but you have industrials, you have consumer discretionary, financials among the worst performers so far today. Taking a look at that 5-day chart, this tells us, it gives us a better idea of the degree of that selling action that we have seen so far this week. All of the sectors are in the red here this afternoon, or excuse me, for the week here. You do have financials off just about 6%. The worst performer so far this week, consumer discretionary, energy as well here. So again, that downward movement that we have been seeing playing out once again today. We'll see what that brings. But again, some concern here, to say the least, has been introduced here to the market. And of course, investors trying to figure out whether or not it's time to buy following that move to the downside. Let's kick it over to Jared Blickery for a closer look at some of this movement that we're seeing at the open. Jared.
Yes, Seana. I just wanted to linger for a second. I was going to hit the sector action, but you hit it. The weekly, they're not looking too bright. Financials, discretionary tech, so a mix of value and growth leading the way down. But I'm going to go back to the indices. We just had the worst day of 2025 yesterday in the S&P 500. Let's put the year to date on. You can see we're down for the week, and it's actually the worst day since the worst day since December 18th of last year, and that was a Fed day. I keep referencing that a lot because that was a big down day. Nasdaq Composite also falling to a 5-month low, but I want to move on to the VIX, and I'm going to be doing a deep dive in the VIX in about an hour here, in the 10 a.m. hour. And what I'm noticing here, a lot of times the VIX, when it spikes up, sometimes it'll come back down really, really quickly. I'll put a 1-year chart on. You can see just 1 or 2 days to the upside, followed by a big down movement. We are seeing the VIX very comfortably staying above 20, and that just tells me we might be in for a prolonged period of volatility. If it drops back below 20, it takes a lot of pressure off. We can also take a look at bond market volatility, the ICE B of A Move Index at the highest level since November, so that's a very similar story. And I also want to show you what's happening in the US dollar, which is now down 5 days straight. This is a 1-year chart. I'll show you the year to date, and you can see since the year began, it has been a steady drop until recently when it got a lot steeper. So let's get back to some heat maps here. We already did the sectors, so I'm going to move on. I want to take a look at the NASDAQ and just kind of focus on the Mag 7 for a second. We have most of them under pressure. Broadcom up 5%, not technically Mag 7, but it does have the market cap horsepower. But I want to show you what's happening with Tesla. Tesla is now falling within a few percentage points of its November 5th breakout, and that was the election day. So all of the Trump bump here is getting priced priced out. We're not quite at that level just yet. We're at 0, but we are pretty close. And a very similar thing could be said for Microsoft, for Amazon, and also Alphabet. You take a look at Amazon, there were all those photos of Jeff Bezos with Trump in the election. That bump, though not as big as Tesla, that is getting reversed as well. So let's move on. I'm going to close with Bitcoin. That has been a pretty good risk barometer recently, under a little bit of pressure today. And let me get back to an intraday chart. You can see really not that much reaction off of the 8:30 a.m. report. Maybe Bitcoin operating on its own fundamentals today, but not a leading indicator. Only takeaway here, holding steadily under 90,000. And the support level to watch is in the low 80s. So we'll keep an eye on that. Back to you, Seana.
All right, Jared, thanks so much for breaking all of that down. It's time now for today's strategy session. Dip buying has boosted U.S. stocks in recent years, but now investors have adopted a sell the rally mentality. That's according to J.P. Morgan, as the S&P 500 struggles to find a floor. The benchmark index now down 7% from its recent highs. Joining us now from more is Yahoo Finance's head of news, Miles Udlin. And Miles, I'd love just to get your sense and your sentiment just in terms of the degree of the selling that we've seen and I guess how tough of an environment it is right now for equities.
Well, Jared was talking about the NASDAQ heading into correction, and I think what's striking about that is the speed with which we went from record highs into correction territory. It was only on February 19th that we saw record highs, record closes for the stock market. Of course, in 2020, we also saw February 19th record closes as well. A little bit of symmetry there, but I think the problem that you have for the market right now, if you want to say where are the dip buyers, is there are really two distinct reasons that someone might come in and say, I want to either degross or just outright sell some of these names that I've been holding on to. The first is the one that we talked about. We talk about endlessly, valuations, is it AI, all these AI plays, watching how the S&P 500 has gotten skewed with certain of the mega cap names doing so much, not just of the price performance, but of the earnings performance as well. Any thought that there's a slowdown in growth, and you really saw it on that quilt with consumer discretionary, tech, really driving that downside action. You have that factor, and then obviously all the tariff headlines, all the concerns that might bring about, just the state of the consumer, state of the economy. That's kind of the macro reason, and there's always macro reasons that come and go. And I think the buy the dip meme is really has been built on the idea over the last decade that the U.S. economy, in a macro sense, will work itself out. And that has been true, right? That was true in 16, that was true again in 18, that was certainly true as we came through the pandemic. And the question now is do you think that President Trump is a reason that doesn't work the same way? People can debate that, and the market's obviously going to work that out in real time. But when you combine that with just the, let's call it the spreadsheet reasons to be more concerned about markets. That's a 1-2 dynamic that isn't great, in the near term here. And I think why we've seen so much downside momentum in the last few days.
And then I think that also just illustrates how tough it's going to be in order to turn around that downside momentum, right? Just given the pressure and the fact that it's coming from multiple sides at this point, and whether or not that also just caps any sort of upside movement.
So I think, and I think you're starting to see, look at an individual name like Tesla. Yeah. You have multiple analysts out in the last 24 hours defending the name. That's how it starts on the valuation side. So you have analysts come out, whether it's top-down strategists who say, we still like S&P 6,500 by year end, something like that. We like this name off 30%. Even names like Nvidia, coming down from 150-ish to about 110. There's still a lot of people who were in the name at 60, 70, and might look at that pullback as a reason to get involved again. You're going to see, I think, on those individual names and the top-down strategy piece of it, that first cohort of here's why this is more attractive. On the second part, around policy, around tariffs, that gets a little trickier, I think, I think that stuff is always tricky on the way up or the way down for investors to make a firm I want to be overweight tech now because of whatever, tariff policy. I think that's a more complicated one, but you're going to start to see, I think, given the general bullish slant that we have on the street coming out of what happened in 23, coming out of what happened in 24, you're going to start to see a lot of defense of the individual names, of the individual tilts, and probably as we get into next earnings season, defenses of, our earnings estimates aren't really coming down, and so now the valuation actually looks cheap relative to what we were pricing in. Therefore, we are recommending X, Y, and Z.
I guess also just my question to you is, outside of that and even just the fundamental side of it and more so the rhetoric side of it from the White House, just how much investors are able to ignore some of that noise. And I guess how much tougher that gets given the continuous whipsaw sort of action.
So Lori Calvasine at RBC had a note out this morning about, like investors who thought that this was, the literally versus seriously thing, thought this was all just a negotiation. Those investors are clearly mistaken. And I think it really just depends on what your mandate is, right? Like what kind of money are you running? What's your portfolio look like? What did it look like coming into this year? Again, what were your tilts? Were you way overweight this? Did you want to be underweight that, et cetera, et cetera? You clearly cannot ignore that as an investor, but I do think over the next couple of months, it is most likely, again, given you have so many investors who believe this is a 25-year bull market, this is a cyclical, spin within a secular bull, all these kinds of frameworks, you are going to see more and more investors, more and more strategists come out and say, okay, I can actually make my peace with tariff X on this import, tariff Y on the other, but I don't think that's going to mean we're going to see S&P, I'm not going to model S&P earnings coming down, $10 a share, $20 a share. Therefore, I am comfortable re-entering this trade, that trade, the other trade at these levels. And I'm comfortable, I don't want to say looking through the noise, but I am comfortable with the realities of this is the trade, this is the new trade relationship for the U.S. And I still think the U.S. companies that I am buying and recommending, I still think they will earn. Therefore, I'm going to buy the stocks.
Very much stock pickers market. All right, Miles.
It always is. Come on, please.
All right, Miles, a pleasure. We'll turn now to the February jobs report and the broader strength that we're seeing in the U.S. economy. Mark Zandi, Moody's Analytics, a chief economist, joining me now. Mark, just give me your sense of this jobs report. I think initially, obviously, some sort of relief out there that it wasn't below the 150,000 mark, but there is some issue when you take a look at the fact that unemployment did rise just a bit. We take a look at labor force participation. So what was your biggest takeaway?
It was mostly down the strike zone, Seana. I mean, 150K, kind of sort of where average monthly job growth has been for a bit here. Enough jobs to keep unemployment close to that 4%. Not too many jobs that it would generate inflation worries or higher interest rates. So kind of sort of down the strike zone, maybe on the softish side of where I thought it would be, but barely on the softest side. But it's one of those. There's a lot of clouds out there, some storms. Things are getting pretty dark. So I think I'd soak this number up. I think it might be the best number we get for a while.
Things are getting pretty dark. Mark, what does that look like?
Well, if we keep going down the trade war path, I do think we're going to see much weaker job numbers dead ahead. Depending on how things play out here, you can even start constructing some recession scenarios. I'd put the odds of a recession starting in the next 12 months at close to a third, which is up quite a bit from where I was just a couple, 3 months ago. And that goes right to the trade war that's unfolding. I had thought that, the president, after some back and forth on tariffs would back away from them, and declare victory and move on. But it doesn't feel like that's happening. Obviously, I don't know how this is going to play out. There's just a boatload of uncertainty, and that's part of the problem. But it does feel more likely that the tariffs are going to be around for a lot longer. More countries are going to be involved, more products, more companies. And if that's the case, I do think it's going to be tough for the economy to digest that in the context of everything else that's going on with regard to economic policy. So I am growing more concerned about the economy's prospects.
Mark, is it the tariffs themselves, or is it the uncertainty that's been created by the administration that is the biggest threat to the economy?
Well, right now it's the uncertainty. Like, you're a business person. What do you do with this? I mean, the president said, okay, we'll take the tariffs off Canada and Mexico for another month. I think that's what he said. I mean, it was for those products that are under the USMCA, but there's a lot of products that aren't, but who knows? But that's the issue, the uncertainty. What do I do with this? It's the stroke of the pen risk, right? If something can be changed by the stroke of the pen, a business person is going to have a hard time making an investment decision based on that, or a hiring decision, or a layoff decision. So it feels like the economy already is struggling under the weight of that uncertainty. And then it's the tariffs themselves that are going to matter. If you raise tariffs by 25% on Canada and Mexico and 30%, now we have 30% tariffs on China, that's real money. That's a real tax that American consumers and businesses are going to pay. and they're going to have a problem with that. It's going to hit spending, and then all of those things are coming together and weighing on the equity market, the stock market, which you talk about a lot. And the stock market is central to the economy's performance because a lot of the spending that's being done is being done by the well-to-do, and they're focused on their stock portfolios like a laser beam. When stock prices are up, they feel good, they spend more. When stock prices are down, they spend less. That's a problem too. So I can go on and on and on, but all it adds up to a much weaker economy, even again, potentially on the scenarios, a recessionary economy down the road.
Mark, you just mentioned consumer spending, and we have a chart from Moody's, actually, just in terms of how reliant that consumer spending has been on that higher income, higher end consumer as of late. How big is this a massive red flag here for the economy?
Yeah, it's a matter of concern. The work we did showed that the folks in the top 10%, 20% of distribution count for the bulk of the spending that is being done. Folks in the rest of the distribution of income, the bottom 80% of the distribution, are kind of barely holding their own. They're spending, they're doing their thing, but it's the folks in the top 20%, the top 10% that are driving the train. And they're doing well on all fronts. They've got a job, wage growth is strong, they're getting bonuses. But the thing that's providing the juice, that's really powering their spending is their wealth. Their stock portfolios feel they're up. Housing values are up. If they have any debt at all, it's a 30-year fix. They locked in when rates were very low. So their balance sheets are really strong. But stocks are key to that. And if stock prices start heading south in a consistent way, and obviously we're now moving in that direction, that's going to knock the wind out of their spending. Not that they're going to cave and cut back, but they're just not going to be quite as aggressive. And because they're so key to all of it, that thing means the whole economy slows down. And by the way, Seana, the American consumer and the high-end consumer is the key to our economy. It's the key to the entire global economy. We're buying a lot of what's produced overseas as well. So it's really very important that that group continues to feel good about things and continues to spend.
Yeah, also illustrates the potential threat there just to the global economy, obviously just outside the U.S. as well. Mark, always great to talk to you. Thanks so much.
Sure thing.
Coming up, we will break down the White House's strategic Bitcoin reserve plans ahead of its crypto summit later on this afternoon. We'll be right back. Bitcoin trading above 90,000 after the White House issued an executive order establishing a strategic Bitcoin reserve. It was actually initially met with disappointment, but we've now seen a bit of a reversal here with Bitcoin moving to the upside. Joining us now from the White House with more is Yahoo Finance's own Jennifer Schomburger. Jen.
Good morning, Seana. President Trump officially issuing an executive order Thursday night establishing a strategic Bitcoin reserve just as the president is set to host the first ever crypto summit from the White House this afternoon. Now, this reserve will consist of Bitcoin owned by the federal government that was seized as part of criminal or civil asset forfeiture proceedings. White House crypto czar David Sacks, it means that taxpayers will not pay a dime. Sacks estimates the U.S. government owns about 200,000 Bitcoin, but says there has never been a complete audit. Now, the executive order asks for a full accounting of the federal government's crypto holdings. Sacks says the U.S. will not sell Bitcoin once it is in the reserve and will be kept as a store of value. He said, quote, "The reserve is like a digital Fort Knox for the cryptocurrency often called digital gold." Now, this executive order also directs the secretaries of the Treasury and the Commerce to come up with a budget-neutral strategy to purchase more Bitcoin, provided it does not cost the taxpayers extra money. This executive order also creates a second crypto fund, a U.S. digital asset stockpile that will consist of crypto other than Bitcoin, and it will be solely comprised of crypto seized from criminals. The government will not look to purchase extra crypto like it will with the Bitcoin fund. Now, separately, Senator Elizabeth Warren sent a letter to David Sacks this morning questioning him about potential conflicts of interest. Sacks, however, has said on Twitter previously that he has sold all of his crypto holdings prior to entering this administration. He also sold a $74,000 position in Bitwise's ETF on Monday. Now, Shauna, this creation of the strategic Bitcoin reserve fulfills the president's campaign pledge, and it was order number one as part of the president's digital asset working group, started at the very beginning of his administration. Back to you.
And Jen, certainly when we start to think about maybe what could come out of the meeting later on this afternoon, obviously this gives us some sort of insight into how the administration is thinking about the industry at large. But from your reporting and the sourcing that you've been doing, what are you expecting to hear in a couple of hours from now?
I think there is going to be a lot of excitement around this. The mood is pretty euphoric here at the White House, as well as inside the industry. Coinbase's CEO Brian Armstrong said this morning on Twitter that, quote, "It's incredible execution from the Trump administration. Coinbase is going to be hosting a reception, in fact, following the summit this afternoon, set for 3 p.m. here at the White House with industry officials and members of the administration. But, you know, we're all going to be looking for more color on how this is going to work, what the aim really is here for, because crypto, while it is known as digital gold, is a bit different than gold. And so will this create some sort of a floor under Bitcoin? And what will that mean for the industry? I mean, this is clearly the administration's way of trying to put the U.S. at the forefront of crypto in the global arena. So looking for many more details this afternoon.
All right, Jen, thanks so much. We're looking forward to your reporting from there. Well, as the White House gears up for its crypto summit, the industry will look for more answers from the administration on its plans for strategic reserves after the initial announcement didn't include any additional buying of the tokens. Joining us now for more on what to expect, we have Brady Dale. He's Axios, a crypto reporter. And Brady, before we get into exactly what to expect, I'm curious just to get your reaction to the move initially to the downside that we saw here in Bitcoin following the announcement. Now we're seeing some relief here. What was that initial hesitation in your mind?
Just sell the news. It happens every time. If there's some gigantic thing that's expected, weirdly, Bitcoin always tanks right after the thing everyone was waiting for comes. So I think that's all it was. I think it's temporary. It's weirdly normal.
What kind of clarity are you going to be looking for, or is the industry hoping that we're going to get surrounding the reserve?
The two things I'd really like to hear about is just one, what are these budget neutral strategies for buying more Bitcoin? You know, the government is a very big place. I'm sure that they have some interesting ideas there, but I can't imagine right now what that might be. And then the other thing is, what is the larger strategy for this Bitcoin? Like, what do we intend to use it for? Is the only idea here just boosting a strong American industry, or is there some other intent? I suspect that there really isn't much of a strategy besides just hold on to it forever. But if they have more of a thesis there, it would be great to hear it.
And how big of a catalyst, real quick, do you think it's going to be for the industry at large in the long term?
I think it'll be big because I think other governments will imitate it, and that gives a ton of credibility to the asset class, and particularly the asset of Bitcoin.
Pretty unfortunately, we have to leave it there, but look forward to continuing the conversation with you very soon. Thanks so much.
Thank you.
Much more ahead. We'll be right back. Taking a look at the major averages, we flip back to positive territory here, just about 30 minutes into the trading day. You're still looking at the S&P on track for its biggest weekly decline that we have seen since September. Much more on the market action when we come back. Catalyst is next. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills, 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour.
First up, we'll break down the market action following the February jobs report as traders seek out direction.
Plus, we'll discuss growing calls on Wall Street that a recession is around the corner, how you should position your portfolio.
And we'll break down the latest on the tariff front and what it means for the companies calling out risks to their operations.